This week on Wealth Track, understanding and managing financial risk.
Sometimes the periods of high risk are actually times where opportunity outweighs the apparent risk. And actually the other side, of course, is true, that the times when risk seems the lowest, it may actually be rising without being that evident.
Noted risk management expert Rick Bookstaber has advice for individual investors this week on Consuelo Mack Wealth Track.
Funding provided by Clearbridge Investments, Morgan Le Fay Dreams Foundation, First Eagle Investment Management, Royce Investment Partners, Matthews Asia, and Strategas Asset Management.
Hello and welcome to this edition of Wealth Track. I'm Consuelo Mack. How well do you understand financial risk? How confident are you that you or your advisor can manage it? Do you have access to financial risk models? Do they even work? Well, those are some of the questions we are going to put to this week's guest in part 2 of our interview with him. He is Rick Bookstaber, the founder and chief risk officer of Fabric, a platform he created in 2018 for providing risk management advice to wealth managers and asset owners. Bookstaber knows the field. He has been chief risk officer for several major financial institutions, both public and private, including the huge University of California pension and endowment portfolios. He had chief risk officer roles at hedge funds, Bridgewater and Moore Capital, and investment banks Morgan Stanley and Salomon Brothers. During the global financial crisis, he worked at the SEC and U.S. Treasury. Among his projects was helping build out the risk management structure for the Financial Stability Oversight Council. And Bookstaber has written 2 highly regarded books on the subject. His most recent is The End of Theory: Financial Crises, the Failure of Economics, and the Sweep of Human Interaction. His first, A Demon of Our Own Design, Markets, Hedge Funds, and the Perils of Financial Innovation, published in 2007, presciently warned of the perils of the explosion of financial derivatives, some of which he helped create. His mission now is to bring his expertise to those who need it most, individual investors who are not playing with other people's money. They are working with their own and rely on it to meet their needs, especially in retirement. I started the conversation with the basics. How does he define financial risk?
So at the simplest level, financial risk is just the probability you might make more than you expected or lose more than you expected. So, standard measure that, if you're going to use one number, could make sense, is what's called value at risk, which is how much, with say 5 or 10% probability, how much might I lose if things don't go well? The problem is, of course, risk is much richer than that. You can't boil it down to a number, but that at least gives you some sort of an intuition of how to look at risk in the markets.
You mentioned, though, at the outset that there was an upside. Financial risk also includes an upside. Is that right?
Well, that's the key. That risk is the flip side of opportunity. It's like a scissor. And so you have opportunity on one side, risk on the other. And of course, the whole decision-making process is to see if an opportunity is reasonable given the risk that it has. So risk is a natural part of any investment decision. And I'd actually argue, and of course I guess I would, given my background, that it's more important than opportunity, because in the market, broadly speaking, it's hard to find unusual opportunities. But risk is just laid bare there to understand and to deal with. So a lot of times for a portfolio manager, and I'd argue for an individual as well, you can take more control of what you're doing by understanding and dealing with the risks than you can by ferreting out unusual opportunities.
And that's so interesting, because the entire emphasis of Wall Street has always been, the buy side. It's what am I going to buy? And there are very few sell recommendations, as you know. So yeah. You're emphasizing what we really should be paying attention to is the downside risk.
There are times where the risk seems harrowing, but it really isn't. And so there is an opportunity. Oftentimes that occurs when people are over-focused on the level of risk. So if you understand risk well, there can be times when the market is just cascading down. And if you understand that there's a point where the dust will settle, that may be a great time to go into the market. Now people say, what are you doing? You're being so risky. But no, it could be that that's a time where risk is really manifest in the market, but opportunities dominate it. So it's not a matter of always saying, watch out, don't be crazy here. Well, you never want to be crazy, but sometimes the periods of high risk are actually times where opportunity outweighs the apparent risk. And actually the other side, of course, is true, that the times when risk seems the lowest, it may actually be rising without being that evident.
It takes a different mindset. What should the goal be of risk management?
So there's the simplest case of risk management, and the starting point of risk management was one of control. That is, you wanted to make sure in the banks and the broker-dealers that no desk was overdoing it, because every trader has the incentive to put on as aggressive a position as he can, because it's sort of like for the bank, it's heads he wins, tails you, the bank lose. But as we've moved forward in time, risk management, as I've mentioned, becomes a kind of part of the equation with the decision-making process. You want to make sure that you're taking risks that are prudent. You want to make sure that you're not overextending yourself to where you can't take more opportunities if they come along. So any investor is actually their own risk manager, or should be.
What are the tools that you bring to bear with risk management?
So the standard, what people do, and the starting point that's there, and every risk management system that's out there does this, is they'll look at the behavior of the markets over the last year or two, look at how risky they were, how much they bounced up and down, and use that as a guide to the potential risk in the future. That might be a start, but you know, when we deal with investments, the first thing anybody says is past returns are not indicative of future possible performance. Well, it shouldn't be that past risk is indicative of future risk either. It's a starting point. So the main tool you want beyond that is to understand the nature of the market today. Is it particularly vulnerable? For example, is it more levered than usual? Is it more concentrated? Is liquidity restricted? These are all things that can indicate that you have a particularly risky and vulnerable market. And if that's different now than the past, the market's different now and the risk is different than in the past. Another thing that's really important is that risk is not a number. It's really a narrative. It's a story that kind of unfolds with twists and turns, because risk occurs in a dynamic market. So you have to end up having something that's sort of a cross between machine and human. You can't simply throw numbers into a machine and think you're going to get a number that represents what could happen, because any sort of event that occurs as a scenario, as a story, and will, you know, have different components to it. So you have to combine experience with whatever you're doing from a quantitative standpoint. And I think the third thing, which is a little more inside baseball, so to speak, is to look at risk not just as risk to assets that you might be holding, to this stock or that ETF, but risk as it affects risk factors. By that I mean things like technology is a risk, is an area of potential risk. China is an area of potential risk. Stocks that are growth oriented is a potential risk. So look at the exposure of your portfolio to China, to technology, to high cap stocks, to growth stocks. Those are the basic building blocks of risk. And if you look at things in that framework, you can do a much better job of understanding the nature of your risks and how different risks might actually thread across your assets and across your portfolio in a way that isn't really obvious if you just stare at things position by position.
You wrote a book called Demons of Our Own Design, and one of the subtitles was The Perils of Financial Innovation. And of course, there's been a tremendous amount of financial innovation in risk management, but some of the innovations which you wrote about in the book have, blew up in our faces. Portfolio insurance, one of the causes of the market crash in 1987. So tell us about the financial innovation and the fact that so many of us think that these very sophisticated, models and algorithms and everything else are protecting us when in fact they could be exacerbating the situation.
If you look at a lot of financial innovations, they add complexity to the market. they often lead to difficulties in pricing. They're new, so they tend to inhibit liquidity. And a lot of times the reason they are put into existence is somebody's found a clever way to end-run regulation, or a clever way to basically arbitrage the markets. So, you know, if you look at CDOs, collateralized debt obligations, before 2008 crisis, they may have started out as something interesting, but then they became the center of a game between the banks and the rating agencies and grew, and then you had synthetic CDOs. It became its own world. Did it add value? I don't know if it added value to the market, but it was something that could allow people to add leverage when maybe they shouldn't have been able to lever, to obfuscate information like the real credit quality of instruments. So by and large, I feel like financial innovation is not quite like what you would get when you talk about technology innovation. It's kind of interesting that in most spheres, we have reduced risk through innovation. You know, automobiles are a clear example of that.
Much safer, right.
But only in the financial markets, we've actually found risk grow as we've added financial engineering and innovation. So that, you know, kind of gets to the point that I'm making.
No, that's really interesting. Rick, how should individuals think about, you know, financial risk? How should we approach it?
I think the key thing is to realize that if you're an individual, you don't have to mark to market. You don't have to account to a client month by month. So there are some things you don't have to worry about that portfolio managers and hedge funds and banks do have to worry about. And of course, those things are on the news right and left. So part of it is knowing what to tune out and what not to tune out. Know the things that you can bypass and things that really matter. And so if you look at the time frame you have, that's going to dictate the types of risks that are important to you and the sorts of risks or the sorts of news items that don't really matter. So marrying the time frame of your goals and your investment with the sort of risks that are important for that time frame is the first critical thing. And the second critical thing is, and this is kind of like Risk 101, but it's not actually as easy as it sounds, is to be well diversified. The problem is if you just hold the index, if you're a passive investor and you're deciding, I'm just going to hold the index.
Like, for instance, the S&P 500, which
Yes.
is by far the most popular one, right?
Yeah. So the S&P 500, or it might be the NASDAQ, which is more technology oriented, or maybe MSCI ACWI, which is sort of global. Those are not actually low risk, well diversified portfolios, even though you might say I'm holding the market. But there are times when the market is high risk and is not well diversified. When you have the top 10 stocks being 25% of the market cap, when you hold the market, you have a pretty strong biased bet.
Right.
So,
and this again is the S&P 500 and tech stocks. How do we become better diversified?
Well, so you can do diversification within your asset class, and then you can decide how much you want to move up and down in your risk posture. So if you take the base case, say, okay, let me just start with zero and go up from there. What's zero risk? Well, zero risk would be hold treasuries that have a time frame equal to when I think I'm going to need money for my goals.
Because you know you're going to get your principal back.
Right.
Right.
You know you got your principal back, and even if rates go up and down in the interim, you might wish you hadn't done it. You might be happy you did, but that's kind of the starting point. Now you add to that the amount of risk you're willing to take, and if you move into equities, then you want to choose a base case there. So you say, before I make any sort of a view, you want to start with a benchmark that you operate off of. Again, the standard people would use for their benchmark is an index like the S&P 500, which you can get to through any number of ETFs. You might have some that's more technology oriented, you might have some that's more worldwide, but you start with that. And then you can adjust from there based on your views in terms of style. Maybe you like value more than growth. Maybe you want to go into stocks that have high momentum. Maybe you want to have a bias towards emerging markets. So you sort of layered up and you've been careful to increment away from some base as you add your decisions that add more specific risks.
Rick, in this day and age, where we're so interconnected globally, is the S&P 500 just a very provincial starting point? I mean, should we all basically be in, an ETF or a mutual fund that invests all over the world and just includes every publicly traded stock, basically?
Yeah. So the MSCI ACWI would be one example of that. It turns out that the U.S. market's about 65% of the world. And a lot of the world's very highly correlated with the S&P. So incrementally, you may not be getting as much as you think you are. If you move from a U.S.-centric portfolio to an internationally diversified portfolio, but more diversification is better than less. And so I would argue to use the broadest diversified portfolio and move towards an MSCI ACWI type of a portfolio as your base.
And where do the other investments fit into this, investment classes? Where do commodities fit in? Where does real estate fit in? Where do bonds fit into this? All the alternative investments.
So some alternatives are not as alternative as they look. So let's take the least alternative, which is private equity. Private equity is equity. It's just private. That is, it's not publicly traded, it's not liquid, and it requires real expertise to understand what you're doing, because if something's in the private realm, it doesn't have the level of oversight and regulation that you have if it's a public equity.
Right, or price movement.
Right, yeah.
Right.
So you may think that a private equity is stable, but that's just because it's not marked to market. You don't see, like you do with a public equity, day by day what's going on. Another asset class would be what you might call corporate debt that's risky in terms of default. And there, of course,
so high yield, junk bonds, that kind of thing?
Mm-hmm. Yeah. And so high yield bonds have an equity-like component, but they're only equity-like if things go really bad. And in fact, they're more and more like equity at the very time you wish they weren't like equity. Mm-hmm. And then when you get into real estate, you have something that's, again, not particularly liquid, although you can get REITs that have a...
Sure, real estate investment trusts that are traded on a daily basis, yeah.
Yeah, so they have a real estate flavor to them. Just like with private equity, to really do it in the right way, I think it's an institutional game, because you have to have a lot of capital, a lot of expertise to look at things deal by deal, and to have major staying power to be in those sorts of assets.
So should individuals keep it pretty simple?
Yeah, I think simple is always better. What you'll discover as an individual, especially if you're working with ETFs, is that if you buy 10 ETFs, the odds are there's so much interrelationship between them that they could be well replaced with little error by 3 or 4. I found individuals who have some ETFs that really basically are no different than each other, even though by name it appears that you're getting differentiation. And so what you think is diversification really is not, but what you are getting is a little more complexity.
And the bond portion of an individual's portfolio, are you still in favor of 60-40, 60% stocks, 40% bonds as kind of a starting point, as the most simple?
I think you could start with something like 60-40, and then the key issue is your risk tolerance and your capacity for taking ups and downs in the market. And obviously a big component of that is where you are now in terms of savings versus dis-savings. So there's no secret here. A lot of the things that are necessary, even at the most sophisticated level, are actually pretty simple. Lowering complexity, maintaining diversification, understanding your assets relative to your liabilities, knowing what you can ignore and what you can't ignore based on the time frame you have until you retire, until you meet whatever your goal happens to be. So if you're 20 or 25, you can sort of sidestep and step back for the ups and downs that occur even when they're pretty momentous, like 2008. You can't do that if you're looking to liquidate in the next 10 years.
Right.
The basic components of risk management are easy to define. And the key part of this is that risk management is actually more human than people, I think, recognize. There's a lot of numbers, there's a lot of computer crunching, you can get a lot of quantitative results, a lot of statistics. That buttresses or supports what really you're looking at in a market that's dynamic and that changes. As you mentioned, I've been the risk manager at a number of major financial institutions. And when we've had some sort of an issue, and it doesn't have to be like a major crisis, but when there's a risk issue that we want to look at, it's not like we run the computers, come out with a printout, and that's that. The senior people of the firm will get around a table. We, of course, will have an understanding of our positions, metrics of the risk of our positions. But then what we'll do is basically be telling stories. We'll be going through narratives of what might occur. And if things occur, what are the odds something else might occur because of it? That's the essence of risk management. And that's something that really any individual can do if they have an advisor, or if you're an institution, of course, you have a broader set of people to work with. But one of the frustrations I have when I think about risk management is 90% or 95% of what we get when we read about financial markets really does not hit the mark if your concern is risk. And especially if your concern is risk over the time frame that matters for most people. And because, my feeling is that risk is where you have the most opportunity to make a difference in terms of your investments, I think that's a major failing in the type of information that we have available.
All right, and well, you're trying to rectify that right now by educating WealthTrack viewers and me. And I'll just mention one more thing before I get to the one investment, and that is the fact that you told me in a conversation that, and you've written about it, that humans have better judgment about risk management than computer models.
Yeah, so the computer models can do some things we can't. They certainly are better at bringing a lot of positions together, understand statistics, understand history, and so on. But the future is never going to look like the past. And the future will change in ways that require sort of a human sense of what might happen. So, you have to have a melding of human plus machine to do the best job you can in terms of understanding the risks that you're facing.
So thank you, Rick Buchstaber, for bringing the human element to this discussion. Rick, at the end of every WealthTrack, we always ask someone for a one investment idea, but in your case, we're talking about such broad concepts that is there one strategy that we should each individual should be employing?
There is a basic strategy or a basic approach that I believe people can all use. The first is to understand the implicit risks or bets, so to speak, that they're taking in their portfolio, even if they don't realize they are. The example of having a very strong concentration in a subset of the technology space, even if you think you're passive, is a great example of that. Realizing that in the world as it stands right now, you have a very big loading on momentum stocks because most of the stocks you're owning have been going up and up and up. So essentially look at what you're holding not as individual assets, but in a factor realm. What are you holding in terms of technology versus basic materials? What are you holding in terms of US versus Asia versus emerging markets? What are you holding in terms of styles, like more in value versus growth, more in high cap versus low cap? And making sure that you aren't, without realizing it, overexposed in one area or another.
Rick Buchstaber, thank you so much. That's really great advice, and it's also unusual advice. Thanks so much, Rick, for joining us on WealthTrack.
Well, thank you.
At the close of every Wealth Track, we try to give you one suggestion to help you build and protect your wealth over the long term. This week's action point is do a periodic risk assessment of your financial situation. Review your financial goals. How well does your portfolio match them? How concentrated are your holdings? Considering just 10 stocks, including the FANGs, account for more than 25% of the S&P 500's market value, it's not hard to become too concentrated. How leveraged are you? If you have too much debt, you can be pressured to sell in a market downturn. Do you have enough savings to see you through a bear market so that you don't have to sell to pay the bills? Market conditions and personal situations change. Make sure your finances are keeping pace with a periodic review. In the meantime, in this week's extra feature on WealthTrack.com, Bookstaber discusses why he became a black belt in Brazilian Jiu-Jitsu. For those of you active on social media, please keep following us on Facebook, Twitter, and our YouTube channel. Thanks for watching. Have a great weekend and make the week ahead a healthy, profitable, and productive one.